can say, well, today they've bounced back. And yes, it's true. That's true of almost all securities. They have come back to roughly levels where they were a decade or more ago. But with the long week cycle still in process, there's no guarantee that it will necessarily remain at those levels. And so you could take a look at the paper. I also talked there about bonds and talked about several different types of bonds. Emerging market bonds have now become attractive because yield is so scarce. People are starting to look even at some areas they never looked at before. Always remember there are country-specific risks when you get into emerging market bonds. And junk bonds, which are euphemistically called high-yield bonds. They've become popular too. Recognize that yes, there's a nice spread between high yield and treasuries. Also remember that there is no free lunch, so you're taking a risk with that. When people lost faith in the financial crisis, in some of the high yield stuff, the losses were very, very substantial. From late 2007 to early 2009, one of the junk bond indexes fell by more than 40%. So, and it's still 15% or so below where it was back at that time. So there is some big volatility if your timing is not exactly right. Munis, a lot of people are turning to munis. Many people think, well, there are very few defaults in munis. That's true. There are very few defaults. If you go back to some other time periods, there were greater numbers of defaults under real economic stress. And if, in fact, the kind of economic stress that seems possible, given what we're seeing in Europe, occurs, munis could also be an area where you would have to be very, very sure of the credit quality of the instrument that you buy. And I also talked a little bit about real estate. Don't profess to have any real expertise in real estate at all. But I think most people were severely chastened in the bubble in the mid-decade and then the aftermath of that. But I think even though most real estate investors are a much more sober lot today than they were half a decade or so ago, that what they are discounting is the potential that real estate could do what stock markets have traditionally done every time they've gone into a long week cycle. And that is that they have multiple waves, which may include some very nice rallies, but they typically include several really severe declines. If real estate should go through that kind of wave, remember, real estate is not very liquid in most instances. So if you make the decision to go that route, and then you want to change because the macro problems that you see in the country or around the world suddenly give you pause, it may not be easy to extricate yourself from that type of investment. And I would say that it's very possible, and this is a possibility, but not by no means a certainty, but it's very possible that they will go through, real estate investors will go through for the first time in this maybe generation of real estate investors, a two-trough decline rather than a single-trough decline. And if that's the case, then there's going to be an awful lot of money that's coming in now that thinks, okay, I waited it out, the situation has improved, and I'm okay. You know, God willing, that'll be the truth, but it might not be. The other thing, and the last thing I talked about there was annuities. Annuities sound awfully good to people near retirement. I think I better grab some income. I look at such and such an insurance company and so on providing an annuity with a rate that's far above what I could get on a high quality bond. Keep in mind that maybe the picture that we had of the European bank stocks almost down to the 2009 lows. Financial institutions are the issuers of most annuities. If we go into a renewed crisis because of who knows what, something in Europe goes on, we get a bankruptcy, we get some debt starting to default, financial institutions may lose a lot of money. There are many people who believe that many banks are not nearly as sound as they are currently reputed to be. Many people feel there's an awful lot of bad paper on those balance sheets. Some of it, that old real estate paper that perhaps they were unable to get rid of when the Fed was picking up a lot of stuff. Some of it sovereign bonds of sovereigns that are now in questionable condition. So I don't know. It's just, I would keep a close eye on the annuity. I would never put more in the annuity of a single issuer than you would be willing to put in the bond of that same issuer. You know, basically you're relying on the credit quality of the guarantor. So don't be just blindly throwing the money to some great big organization that might say AIG on the front of it or something like that. My brother used to work for AIG. Take a look to page 27. This is a picture of what has happened in some foreign bonds, and Greece is the upper left-hand corner here, and this shows you one of the things that I think I like people to see out of this is how quickly circumstances can change. This is all in the period, say from here. This is from late 2011. You can see, I mean, and that's interest rates on the 10-year going from 20 up toward 40. That's a massive loss of value in bonds. Now, admittedly, this is Greece. This is the poster child for bad sovereign financial condition. But then you go over to Portugal, another one that needed a bailout. And this, by the way, the big drop in rates is the bailout time. I mean, but even now, by the way, in Greece, you got rates on a 10-year over 20%, which says that the market doesn't believe Greece is going to be able to pay those back either. But they're hoping maybe to collect the 20% for a while and then sell it to somebody else. Portugal, similarly, over 10%. That shows real doubts that Portugal's going to be able to pay those off. The bigger questions come down here at the bottom. Here we have Spain, here we have Italy. Spain is about at 5.7, even after a tremendous amount of money has been loaned to Spanish and other banks by the ECB, with which they have bought a tremendous number of their own country's bonds. That has helped bring the yield down. Interestingly enough, it may have amped up the level of risk, however, because what we have seen is that people who formerly held Spanish bonds and then Italian bonds as well used the opportunity of all this new money coming from the ECB to sell their bonds to the native banks in those countries who wanted to buy some of that paper, and we have seen a dramatic flow of money out of Spain and Italy and several other European countries, which now means that we've really focused the level of sovereign risk in the banks of those countries. So you've got, if those countries fail from here, their banking systems have even greater risk than they had before. And right now we're looking at about 5.7% on the Spanish and about 5.4% or so on the Italian. Most people kind of look at 6% or so as the level of demarcation between, you know, maybe they have a chance to pay these off in time or maybe they don't. So even with great assistance, these rates are perilously close to a 6% area over here. And this, by the way, this money going out, this is an interesting phenomenon. You can understand a lot of institutional investors pulling their money out of these countries to drop the levels of risk. What we're also seeing is individuals within the countries trying to get money out of the country. Think about that for a minute. We're now looking at Greece with the very real potential, with the elections of this weekend and so on, of defaulting, because their politicians right now in the first few days haven't been able to form a government. Some of them have even said, we don't even want to form a government right now. We don't like the old rules. We want to upset these rules. If they opt out or are kicked out of the euro and go back to the drachma, imagine if you're a Greek citizen, how much money the drachma, the estimate is the drachma would probably be worth something in the neighborhood of 50% of what the euro is worth. So if you've now got your euros in a Greek bank, and all of a sudden they get changed to drachmas, you have half the money that you had before, the day before. So naturally,